buy low, sell high. It's a strategy that many people, especially even beginners, think is the proper way to trade the stock market. But low and high are really relative terms. Let's say a stock is making a new high today at $30. 2 years from now, it's at $100. $30 is cheap when most people would think, oh, it's at a new high. It's too expensive. I won't buy it. So what is low and what is high? And so that brings up the first problem with the buy low, sell high strategy. Secondly, how do you know where the high is and where the low is? That is why you need to be an experienced, advanced chartist. You need to be very good with technical indicators. This is why I tell beginning investors not to mess with buy low, sell high. Way too risky. In fact, what I'd like to show you today in this video is not only the problems with buy low, sell high, I want to introduce you to what I call buy high, sell high. And that is, why not buy a stock that's going up instead of one that is going down? Doesn't that make more sense to you? Now let's take a look at a very popular stock chart. Okay, I'm not going to tell you what company this is, but you can see that back here in 2009, it's trading down here at around $20 a share. And now you're going to use buy low, sell high. So you're waiting for it to go below $20. Well, I tell you, my friend, this stock went on up over the next 4 years to $100. So you would have made a 500% return if you were not using buy low, sell high, because it never did go below that $20 buy price. But when I say buy high, sell high, look at this. Every single day, it's basically making new highs, you see. So therefore, you could be buying this anywhere along the way, and you're going to be making that 300-400% return by using buy high, sell high instead of buy low, sell high. So let's go back to our buy low, sell high. On buy low, sell high, the whole premise here is to locate a peak and then get out at the top and then buy back in at the bottom. So every day as this stock is going up, where's the peak? You don't know. So what happens is, take a look at, you see a peak right there. The only time you're going to know it's peaking is after it goes there and then it goes back down, you see. And then after it's dropping, then you say, oh, that was a peak. And by then, you're selling way down here. And then you've kind of missed it, you see. And now that you know the peak has occurred, you're probably going to end up selling it right about here. And now you got to kind of figure out where's the bottom. So let's say you got in down here at $25. Okay, and the stock went all the way up to about $30 here. You made almost a 20%. So you figured, okay, I'm going to buy back in when it hits maybe 25 or 26. So you're waiting for it to come down here, and it never does. So you may end up missing buying at the bottom. So what happens is you're waiting, you see it hits the bottom, then it starts going back up. So then you get in right about here. So you see, buying, this is not easy, buying at the top, because if you do not have a way to identify tops and bottoms, then you can get really screwed. As you can see, it's very hard to know where that peak is. But now that time has gone on, we can see that it found resistance right here, and that's probably going to be its peak again. So when the stock comes back up to here, you know that is going to be its peak. But you want to buy at the low. So you're going to have to wait for it to come back down because it's established a low right here. And sure enough, it does hit that low right here. Okay, so by using buy low, sell high, you have to basically miss a whole year on this stock, and then you're going to end up buying around $27 when you could have easily got in here at 10% less by buying new highs. When it's hitting the highs, buying that, you can get in at an earlier time. But anyway, let's say you're at buy low, sell high. You finally get in. Now the thing comes, you figured, well, when it gets back up to this point, I'm going to sell. So when it gets up there, you sell. Now you're waiting for it to come down. You're waiting for it to come back to its price again, down here, you see. But over here, it never does that right in here. It doesn't do that. So while you're sitting it to wait, it takes off, and because you sold right here, you sold around 28. Now that it goes to $100, you missed out. So once again, you got screwed by using buy low, sell high. But just in case, let's say you did time it right and you did get in right here. Well, more than likely you're probably going to sell when it hits the high over here because that was its high before. So now you're going to think, uh-oh, this is the peak, and you're going to sell. And now you're going to sit and wait, and years are going to go by while you're waiting for it to make a new low. And again, you miss out on the 200 or 300% return. So as you can see, buy low, sell high is really not as easy and simple as it seems, and it takes a very experienced person to be able to pull that off. So what I suggest you do is what I call the buy high, sell high. And let me show you exactly how that works, okay? Basically, the way it works is you want to buy when the stocks are making new highs, because every stock that goes up continuously makes new highs. Does that make sense? So that should be a signal that this stock is going up. So let's take a look here again. This is Apple. I'm going to tell you that now. This is Apple that you see right here, and this is just for the 2 years of 2009 to 2011. So let me go over this a little bit. You can see that, let's just say this wasn't Apple, but just some stock. This is this pattern. You can see that it's making new highs in here, so you would be buying this all the time. Now, again, another new high right here. A new high does not mean that is a peak. This right here is a peak. That's where it goes up and then it goes back down. That's called a peak. It could be a new high. It could not be a new high. We don't know. Over here, you see another peak, but it's not a new high, okay? It doesn't make sense. Only is going to be a new high is when it gets past this level right here. You understand that? So it did that right over here. It actually made a new high and a new peak, okay? Because they could be both. Could be the same thing. But this one was not a new high. It was just a peak. So now you have this new high over here. That's the time to buy, around $31, you see, and then the stock goes all the way up to $100 over the next 4 years. A 30% return on your money, okay? So that's it. So now let's draw another line here, you see. Now the stock makes another new high right here. That offers another buying opportunity. So if you missed the first one at $31, $32, you can get in over here at $32 again. Now right here it makes a peak and a new high at the same time. Usually a peak will become the resistance. So we can draw a line across here, you see. So now this one right here is a peak, but it's not a new high, okay? Do you understand the difference between peak and new high? Very important. So this one is a peak, but it's not a new high, okay? A peak again, but not a new high. Finally, it makes a new high here, and it offers another buying opportunity at around $38. This one again, it's at $102 today. So that's another like a 300% return. You see how it's making all these new highs? Here's another new high right here. When a stock makes a new high, it's a great buying opportunity, especially and only if it is on bigger volume, bigger than average volume. If it's making that new high on low volume after a breakout, okay, it's very important that that new high comes on a breakout. So usually you want to find like these red lines here where the resistance is, because that's where it keeps going back down. And once it can break past that, then that means it's making a new high, you see, and that's where you get in. It found resistance, it broke past it. But you only buy if it's on big volume, and I'm not going to go check the volume on all of these, but just basically and generally keeping it simple, you can see how this is going up, up, and up. Okay, now I'm going to expand that chart of Apple, and you can see as it is as of today, for the last 5 years. So remember, don't go with buy low, sell high, because you're going to get shut out. So let's draw some lines here. Oops, sorry, they're not very straight. But you can see where these lines are is where the stock found resistance, okay? It always went up there and then it turned back down, okay? And then you would buy on the new highs, you see, right in here, right in here, right in here. And it'll be 30, 40, about 52. And today it's 102, okay? So right up here, let's say you were lucky enough to buy in right here. Again, using buy low, sell high. Okay, you think that's low. Then when it gets up to here where the last peak was, you go and sell it, you see. So, you know, in 1 month it went from 60 all the way up to $90, a 50% return in 1 month. But by using buy low, sell high, you missed out on that 50% return. But if you would buy on a new high, right when it broke out right here and made the new high past that last peak over here, that was the time to buy. And in 1 month, you would have made 50%, you see. Understand peaks, understand new highs. They are not the same thing. They could be two different things. Time to time, peaks and valleys is very, very difficult. Finding a stock that's making a new high on big volume is just so much easier. So I hope you have learned a little bit from this. And if you're a beginner, do the easy one to get started. If you're an advanced one, then you need to be able to find ways to pick the peaks and the valleys with chart patterns or using support and resistance lines like I've shown you here. Hey guys, William Boyette here. I hope you found those tips very informative. Please, for more tips on trading and investing in the stock market, visit my website, stocklocator.com. And while you're there, please sign up for my free ETF trading report. Good luck, and here's to your success.